Hello everyone, this is Sunny. I'm between these pretty mountains in Idaho. What am I doing here? I am here recording this video trying to give some insights into investing and taxes. So if you've been investing, are invested, or have been investing, and now that it's first week of April is ending and you're doing taxes, this is really important. Of the three insights that I have to share that are really helpful when you're investing in terms of saving you taxes. So, not taking a lot away, might get into it, right? First of all, is as you know, the short term and the long term investments, capital gains are taxed at different rates. So, as soon as you have a long term capital gains, which is like you sold a position that you sold at least 1 year after the date you bought it, you pay less tax on those gains because you're not a trader, you're an investor. So this is one of the ways to promote long-term investing. So what I'm saying here is what you need to watch is in the month of December specifically, before the year ends, you have to keep a tab on what your year-to-date profits and losses are in short-term and long-term. So it's very important to choose a broker or go with a broker which provides you this data. For example, now I use Robinhood, which does not. I requested them, they did not provide me that data, whereas I use also Fidelity, and they did provide me this data. So in Fidelity, you can go on in your portal, you can see, you can click your capital gains or losses realized and for closed positions, and it will tell you year to date, and it will tell you both for the long term and the short term. How does that help? So for example, now in this year, if you had, let's say, $3,000 worth of long term gains, and then you have another position that you've been holding on for a long time, which you've been meaning to sell, to get out of, and you're at least sitting on a $2,000 loss. Well, if you knew then, you could have sold that to offset your long term gains. And if your long-term loss was $3,000 on that position, rather than selling the next January, you could have sold it then and basically pay no tax on the long-term gains. Similarly, you can balance on the short-term gains or losses. So go with a broker that provides you year-to-date details for the profits and losses you're running in short-term and long-term, so that it helps you do that. Again, I'm not saying that you should change your investment strategy or decisions based on the tax year and the accounting of how much tax you have to pay, but it is helpful. It is helpful to know where you are so that you can take decisions accordingly. Second thing is the wash sale rule. So if you've been investing, I think you already know what the wash sale rule is. So I'm not going to go into very detail, but basically it is that to prevent taking a loss on a position and getting into it again and using that loss to offset your profits, the SEC rule is that you cannot make a sale where you are making a loss and then buy back the same security within 30 days of selling. So for example, if you sold a security at a loss at December 31 and you bought it back on January 1st, that will be a wash sale rule. That loss will not count. It goes on not only till January 1st, but 30 days after. So where does this apply? Whenever you make a big loss on a position, may it be like a short term or long term, just, I would say, stay out of that stock for a month. Don't go back into that stock. Use that loss to offset some other gains. Unless, like it's a very compelling position or situation, do not go back. Also, do not buy that stock into your closing of the position. So if you know that's a losing position, you have to close it out sometime. Do not keep adding on to it. Keep a month before that and keep a month after that you will not buy that stock. You'll just sell, use that loss in terms of offsetting the other profits and move on. That's the second one. Third is something that is useful right now. Before that, let's give you one more look of this place. This is actually a water park. These are the mountains. That's actually looks like a football field, a tennis court, and a pretty sunset which is not being captured like perfectly on this camera right now. So let's talk about the third one that is kind of useful right now to talk about is because the IRA contribution is actually open right now. So even though the year has closed, the 2018 has closed, and you can make the contribution to IRAs for that year till the next April 15th. So for example, 2018 taxes you're filing now, you can actually contribute till 15th of April 2019 and file it. If you've already filed your taxes, you can still amend it. You can still make a contribution and amend it. So again, that might be a separate videos all about IRAs, but basically it's in retirement accounts in which it is subsidized in terms of you're contributing to them or making gains on them is subsidized in two ways. Either it's traditional IRA or Roth IRA. Very, very, very basic is traditional, is where you get deduction for putting money in. Not always, depends on your criteria and your various things about how much you contribute to 401k and stuff like that. There's only so much you can contribute with a deduction, but basically you get a tax reduction when you contribute, and then you do not get the gains tax-free. When you withdraw, you basically pay taxes on that gains, but till then you can keep it compounding without paying tax on it, right? Now, Roth IRA is different. When you contribute to Roth, you do not get any tax deduction. Of course, you might be asking why. Well, because it's already taxed money, so you're not getting any deduction on it. It's already taxed. So the thing is that on that you pay. Roth is something where you're not getting deduction at first, but then you will not be charged taxes on any gains you do, and you can pull it out when you get the money out of the Roth IRA. When you check out, you will not pay any taxes on the gains. So that's really beautiful. Personally, I mean, it depends on what your tax bracket is, how much deduction you're getting in traditional and stuff like that. What I do is I contribute only so much in traditional that I get a deduction for. The rest of them I go for Roth. The reasons that I go for Roth are multiple. One is that it's very more helpful if the gains are not taxed, and second is that I like the way that you can pull out your contributions at any time. So after 5 years you can pull out your contributions anytime, and that's really good. In terms of me wanting liquid assets, I want certainty that I can pull off money and don't have to necessarily wait till 60 years old. And you know, like otherwise it's like unless you're 60 years old you have to pull out money, then you have to pay taxes and penalty. So that's really good. So you can pull out every contribution you put in, you just cannot pull out the gains that you have on capitals. That would be taxed in penalties if you pull out earlier. So those are the three things. If you're doing investing, and if you're doing your taxes, and if you're wondering why your taxes look really in a bad shape with respect to you being investing in a certain way, or you feel like because of, sometimes you may actually feel like that you lost the money throughout the year, but you're still paying more taxes because of how much gains you made. Now, and that did not get offset by losses. So this is something to be really careful of, because if you're not careful of taxes while you're investing, it could really lead to reduction of your gains, not only percentage wise but individual year wise. So keep these three things in mind. Go with a broker that provides you the data of what is your short and long term capital gains or losses in a given year to date, and take actions accordingly. Again, don't change your investment strategy per se, but change maybe the timing of certain decisions you might be looking forward to. Second, do take care of the wash sale rule. Do not close and open your positions often. That's what happens again if you're trading. Many times you can lose out to the wash sale rule. So keep in mind for that. Do not open positions after taking a loss like really quick in the same stock, and do not keep buying into closing that loss. And third, you still have time. You still have time before April the 15th to contribute to the IRA, traditional Roth, whatever you may feel like. I feel Roth, I told you why, but your situation might be totally different. Also, you can't contribute a lot. Roth has a limit of $5,500. That's also if your salary is less than $122,000 yearly. So there's a lot of things. You can't contribute to it all the time. So when you can, it's good to do it. And the sun is shining. It's not sunset yet, so I like the sun after that winter. So hope this video was helpful and it was great. Let me know if you need any other specific thing that you need me to cover on. See you. Happy investing. Sunny.